Good afternoon to you, our valued clients, and those who are new to our platform. My name is Seng Yao, and I will be your host and moderator for today. We start the week on higher Brent prices and lower US futures. But the interesting observation this morning is that Dow, S&P, Nasdaq are only set for modest losses. And as far as Asian markets go, the pullback has also been relatively mild. So one theory is that if oil is at all a factor behind this current situation of the market, OPEC minus Iran still has ample supplies to cover Iran's shortfall if it were to stop exporting oil. The math basically breaks down like this. Iran produces 3.2 to 3.4 million barrels per day of oil. It exports roughly half, about 1.5 million barrels per day. OPEC's spare capacity based on mid-2025 estimates is also roughly 3 to 3.5 million barrels per day. These surplus capacities are mostly concentrated in Saudi Arabia, which holds about 1.5 to 2 million barrels per day, and UAE about 0.5 million barrels per day. So in theory, OPEC has enough spare capacity to replace Iran's roughly 1.5 million barrels per day loss. But whatever theory is lurking in the background, it is clear that markets are watching for Iran's response to US bombing. The big question is what comes next from a militarized response should Iran decide to retaliate. There are basically only two scenarios at hand based on what the media is reporting. One is, will Iran attack US interests directly or through allied militia? Two, or will Iran attack shipping routes in the Straits of Hormuz? Now, under this cloud of uncertainty, the risk of higher market volatility is certainly there. And this afternoon, we'll be featuring our key calls on tech, Sea Limited and Grab, telecommunications. We'll be talking about Singtel, and a new consumer staple initiation out of our Indonesia research team. And the company is Mulia, Boga, Raya. But before this, we would like to first show a pre-recording with Dylan on Singapore Exchange. And he will walk us through basically his insights if greater market volatility is going to help SGX stock price and whether these trends are going to be structural in nature. So let's cut over to the video right now.
Hi, Sangya. We are upgrading SGX's target price to 1609 and retaining our buy call. We think the cash equities daily turnover boost we are seeing is actually structural. So far this year, average daily turnover is about 20% higher than what it was last year. We see several factors contributing to this and will likely continue to contribute. First is flows rotating out of the US and into other markets, particularly markets with policy certainty. Now, this weekend's activities of bombing Iran and all that clearly shows that the policy certainty around the US is becoming less and less. So I think investors will be looking for markets where there is clear policy certainty in terms of what the governments intend to do. And I think that in that area, Singapore stands out. Second, a lot of the corporate capital return momentum is accelerating. This is providing yield support with higher dividends. And also we are seeing share buyback activity picking up. Share buybacks so far this year is 76% higher than what it was in the same period last year. Third, there's a construction boom happening in Singapore, which we haven't seen in about 15 plus years. And that's actually driving a lot of earnings upgrade for stocks beyond just the STI. And finally, domestic rates continue to come down. We saw the T-bill rates touch 2%. So we think a lot of this will rotate money into domestic equities, which is something that we haven't seen in a while. Separately, we also have to consider equity market reform. We discussed this in last week's show, that we are pretty optimistic about what MAS is doing, and we think that it will help drive market velocity and valuations. So we've actually raised market velocity assumptions, which is how much the market turns over relative to its market cap, from 37 to 40% to about 41 to 42% for 2025 to 2027. This is still fairly conservative compared to what we have seen the SGX market going to, which is the high 40s prior to the GFC period. And apart from equities, we also need to think about the derivatives business as well. This contributes 52% of SGX's revenue, and we are seeing increased volatility everywhere across different markets, across different asset classes, across commodities, and particularly in areas like FX and current, as well as commodities. We are going to see a lot more uncertainty, and I think that's going to drive more demand from hedge funds, from investors, from financial institutions to hedge risk, and that will drive the derivative volumes. And again, I think this weekend's rising Middle East tensions also prove that point, that there will be more and more demand for risk management, particularly in areas like commodities. So overall, we've raised earnings for SGX by around 2 to 5%, and we updated our target price to 1609, and we maintain our buy call.
So for anyone who is interested in reading the full report, you could actually rewatch the YouTube video of this recording later in the day, and the QR code to Tillan's report will be there, right? So we're going to basically jump over to the tech sector right now. And for many of you who are following this space in the market, you will notice that the tech sector in the US has actually rekindled a lot of interest, and is actually driving a lot of the flows at this point in time. So what we want to do right now is basically go over to Hosseini, our regional tech analyst, to basically go through some of his observations about Sea Limited, Grab, as well as the telecommunications sector, where he will be talking about Singtel. These three stocks would be of a significant interest to you, and in terms of your portfolio balance. So let's go over to Hosseini at this moment. Hosseini, in your recent report on the sector, you're very positive on Sea. You're relatively more mixed on Grab, and you believe that the telecom sector could rekindle interest. So first on Sea, are you not concerned with the stiffer competition that is coming from Meli, MELI, Meli's move to basically lower free shipping threshold from the Brazilian real from 79 to 19 just recently? Can you talk us through this, please, Hosseini?
Sure. Thanks, Sangyao, for having me. So we have put a report on the back of this news flow that Mercado Libre or Meli has increased the competitive intensity in Brazil. See, the point is that both Mercado Libre and Shopee are the main winners in Brazil's e-commerce landscape. Okay, Shopee has gained market share, no question about it, but it's not that it has gained at the cost of Mercado Libre. Both have gained. Maybe Shopee has gained at the cost of other players like Magazine Luiza and Amazon and many other players in Brazil. Okay, now going to specifics of Mercado Libre, that what Mercado Libre has done is that it has bring down the threshold of free shipping from 79 to 19 real, as you mentioned, but that threshold comes with a slower shipping timeline. Okay, now Mercado Libre is known for a very fast shipping, 1 to 2 days, but for this free shipping program, it will come at a delayed or slow shipping delivery of around 7 to 8 days. And in our view, it's not a major escalation because, again, both are the winners. And more importantly, Mercado Libre is a market leader in Brazil. So from the numbers point of view, Mercado Libre is around 48 to 50% of market share, whereas Shopee is much smaller. So it doesn't make sense for the market leader to increase competition, as well as it doesn't make sense to increase competition when you yourself are a winner in the market. So in our view, it is more of a measured increase in competitive intensity. Shopee so far has not responded, and we are of the view that the overall growth in Brazil should continue. And as a matter of fact, the growth in that market is much superior, much higher, maybe compared to ASEAN markets.
Okay,
So
thanks.
I'm not pretty concerned about that.
Okay. What about C's gaming business? Can you give us some insights in terms of how that part of the business is developing?
Okay, so within the gaming business, the key business over there is Free Fire. Okay, they have certain publishing side of the business as well, but majority of the revenues, I think, the lion's share comes from the Free Fire. Okay, and I was, meeting investors in Singapore and KL in the last week. One of the questions we are getting is that some of the companies have launched new games, AAA games. So does that create some risk for Free Fire? Now, in our view, the risks are limited because if you see the upcoming game launches, say from Tech 2, which is GTA 6, data are mostly focused on console as well as PC-led games. Those are PC-led games, console-led games are targeted towards developed markets and Chinese or North Asian kind of gamers. So it doesn't compete directly with Free Fire. Free Fire is mostly centered in emerging markets like Latin America, Southeast Asia, India to an extent, Africa, and Middle East. And more importantly, Free Fire is a mobile first game, right? So as such, it doesn't compete with those AAA games from other which had been released earlier this year or for the upcoming releases, and as such, we remain quite comfortable. For this year, we expect Free Fire, or for that matter, C's Garena business or the gaming business to grow at 20+% rate. And going forward, we expect it to grow at a low to mid single digit. One more thing, Sengyao, I just wanted to highlight is that keep an eye on the upcoming in-house developed game of Garena, which is called Free City. It has been launched selectively in few of the markets. Initial indications are that it is getting good traction. So in our view, that remains a potential catalyst on the gaming business as well.
Okay, great. Thanks for that note. Let's talk about the Grab. Um, so in the latest corporate development for Grab, the company is raising 1.5 billion US dollars via convertible notes. Where do you think the money is going?
All right, yeah. So, Sanya, if you see our report and if the audience can see our report, it is titled as attempting to connect the dots. So we are not saying that we are connecting the dots. We are saying we are attempting to connect the dots. So essentially, the point is that we ourselves are not very clear where this 1.5 billion dollar will go, because the starting point is that the company's net cash liquidity is already 6.2 billion dollars, 6.2 billion USD. And for an 18 billion dollar market cap company, it is very big. Okay, so the starting point, company doesn't need capital. There had been talks in the market, and we had been writing on it quite a lot, that there had been talks that Grab is looking to acquire Goto or some kind of M&A, but uh, both the companies have denied it. Okay, so again, we are not very clear that they are going ahead with merger. And even if they are going ahead with merger, the sequence of event doesn't make sense, in the sense that typically for companies going for M&A, they first do M&A, and Grab obviously has quite a bit of capital to do that, and then go for long-term financing option. Whereas the company has first gone for long-term financing options and then potentially go for M&A. So the sequence of event doesn't make sense as well. Then the second point is that is the company need the capital for organic growth? Again, the capital is there in the first place, so it doesn't need that much of capital. The only area it needs some capital is the fintech business. And again, the fintech business, in our view, is not a very scale-up business in the sense that the loan book over there is, I think, somewhere around 500 million USD, and the growth outlook for the fintech business is also a very conservative and very ecosystem led. So company doesn't want to go very aggressive into that business as well. Whereas its other parts of business, which is ride hailing and food delivery, the company is already free cash flow positive. So from the organic point of view as well, we don't see the company needs that much of capital. So finally, it leads us to our third point, which is that either the company is bracing itself for a new entrant. So if you see the Chinese companies or Chinese behemoths like Meituan and Didi have moved out of China into markets like Hong Kong, Middle East, Africa, Latin America, and in some parts of Europe as well. So potentially, Grab is bracing itself that what if this companies also comes to Southeast Asia, then they need capital for that. So in our view, that could be one of the reason. The other reason could be that if you look at the shareholding of Grab, it has big names like say SoftBank, Toyota, Uber, and Didi. So potentially company could be bracing itself that what if this one of the shareholder say exit, then it will lead to excess liquidity into the market. So they may need a capital buffer to go and buy back those shares so that to support the share price. Again, these are the dots we are trying to connect. We don't know. It's just our attempt to connect those dots.
Okay, Husseini, then so based on what you just explained, with so many different possible scenarios that the market could anticipate from Grab, which element do you think, if it were to materialize, would likely move the Grab's stock price? Would it be in the delivery space, in the mobility space, or in the fintech business that you just talked about earlier?
Yeah, sure. So if Grab and Goto or Grab and Gojek kind of M&A takes place, then in our view, that would be a positive outcome. And we had done quite a bit of work on that side. And in our view, if that combination takes place, then our NPV of Grab will increase by around 12%. So in our view, if that kind of M&A happens, then it will be a positive outcome for Grab.
Okay, great. Could you just remind the audience in terms of your fair value target price for this company?
So for Grab, our fair value is 5.85.
Okay.
And it doesn't assume any kind of M&A. So if M&A happens, then it will be a positive outcome.
Okay, great. Thanks. And on the telecommunications sector, Husseini, on Singtel, this stock has been kind of hovering around just below the $4 mark for some time now. Every Singaporean owns it. What's going to basically drive this stock beyond $4 in your opinion?
Okay, sure, Sangyo. So we met around 20 investors last week. On Singtel, that was the consensus question in each and every meeting. That was the key question, that what could drive the stock beyond $4. In our view, there are three catalysts. First is that if you see the company's holding company discount, it is still quite wide at around 25 to 30%. Pre-COVID, the same holding company discount for Singtel was somewhere around 10 to 15%. Okay. Now, for a company, the way I flex Intel is that it's a combination of 8 different businesses. 4 core businesses of Intel, which is Singapore, Australia, Optus, NCS, and data centers, and there are 4 associates. So of those 8 businesses, 6 are in real good shape. Okay, and 2 of them which are facing some challenges is Singtel's mobile business in Singapore and Globe business in Philippines. But these 2 businesses only contribute say around 15% of the SOTP. So essentially 85% of the SOTP is in a very good shape. Company's balance sheet is in a very strong shape. And on top of that, there are a host of capital management initiatives which company has initiated, which leads to an easy 6 to 7% total shareholder return. So in that context, that the business is in good shape, balance sheet is in good shape, and a 6 to 7% TSR, I am of the view that this 25 to 30% holding company discount is still quite wide. It should further narrow down. And that, in our view, remains one of the catalysts which can drive the stock past $4 mark. The second is that the data center side, in the sense that the data center business obviously is doing good, but keep an eye on the upcoming launch or start of its Singapore data center, which is a 58 megawatt TUAS data center facility. In that business or that data center is with very high specification. It is liquid cool. It can have high density AI GPUs. It can host those kind of AI GPUs. So the launch and some announcement linked to that data center, in our view, remains a catalyst. And the final one is the Optus business in Australia. That business was quite a bit of pain for Singtel in the last many years, but now it looks in a very good shape. Going forward as well, we see more catalysts in place, like, Australia, the economy is doing good. There is quite a bit of cooperation within all the telcos in Australia to price up, and there is still more room for Optus to cut costs as well as capex. So those are the catalysts as far as Optus business is concerned, and we see there is further upside on the Optus side for Singtel. So those are the three catalysts as such for Singtel, which can drive the stock past $4.
Thank you. One last point about Optus. The 100 million that Singtel just settled with the Australian Telecommunications Board, is that full and final, or will there be more to that is coming along the way?
In our view, that is full and final. So it is an amount which is agreed between Optus as well as ACCC or the Competition Board. It has to get a final mark from I think, the judiciary, but at least between the parties, it has been settled. So I think it is. I think that it is a final amount, and it has already been provisioned in the last fiscal release of Singtel. So I don't think that it is likely to impact the earnings. And the 100 million penalty is linked to something what happened from 2019 to 2023. So the reputational damage linked to that is also in the past. So I don't think that going forward it will have any major bearing on Optus performance as well as on the financials, or as such on Singtel's ability to pay dividends.
Okay, great. Thank you very much for that, Hussaini. Now, as we all know, in moments of crisis and market volatility, the utility sector, including the telecommunications sector, will come into the limelight of institutional investors. So Singtel is certainly one stock that you can consider within your portfolio. And just like Singtel, we now move over to Indonesia, where there's a lot of attention about the state of the market in terms of its valuation, and of course, the latest initiation from our consumer team, headed by Willy Kautama, who is on screen at this moment. So, Willy, want to talk about your new initiation on Mulia Boga Raya. This company actually manufactures cheese. And in a populous country like Indonesia, and where investors like the fact that, despite all the mayhem that we're experiencing at the moment, with external trade and the fact that this 90-day reprieve with the U.S. Tariff reprieve in the U.S. is coming due in July. So a lot of attention is actually on markets and sectors that can actually sustain its own. And Indonesia and the commercial and the consumer sector are clearly one good example. So can you first talk us through, from a strategic standpoint, how does a local company like this actually take on giants like Unilever? Willie?
Yeah, yeah. Thank you, Sanyo. So, Yeah, interesting observations that we made on not only for this company but also the other multinational is that um, many of those are struggling in delivering innovations to the market. When it comes to the pace of the bringing innovations to the market, they are lagging off those who are more established, like the local players. So one of the key reasons why is that back in 2022, we have been observing that in terms of the tax rate for royalty payments, Indonesia and the other Southeast Asia countries is considered as one of the lowest in the countries. So from multinational point of view, this create an opportunity to actually pull some of the earnings from these countries back to the parent company. So with that mindset, I think many multinationals in Indonesia try to put profitability over market shares. And that said, we have been seeing that these multinational companies is more aggressive in raising the prices. And the companies like Mulia Boga Raya, which we just initiated, simply plays on the price. So they offers cheaper alternatives to its target customers. So I would say first thing first is value for money. That's the aspect that they have addressed well to their target markets. And with that reason, I think they have been able to gaining market share from the giant multinationals like Kraft in this sense, in this cheese market. Yeah.
Okay, all right. Now, Willie, in your report, Mulia Bulgaria's primary production input is cheese curd, which you estimate accounts for quite a hefty 40% of the company's cost of goods sold. As the primary sourcing comes from New Zealand and US, what assumptions did you or the FX team make whether this level of the Indonesia rupiah is sustainable?
Yeah, back at the envelopes, I think I'm putting in 16,350 rupees per US dollars for this year, and for next year I'm putting 16,500. So basically, the reason why I've been a bit more bullish versus the consensus is that we think that with current situations, just look at into our recent trade balance data, we actually doing good and not as bad as what market expected. And
Mm.
I think from this point of time, I've been seeing that the government has been more realistic in terms of bringing the actual spending. So if you follow the news outlets, the government in the beginning of the year have been setting an unrealistic target when it comes to the growth front, when it comes to the way they spend. And
Mm.
I think for the latter, I think the government has come to realization that the rollout of your program takes time. So I think by having those facts in the government mind, I think that helps in terms of the bringing a healthier financial balance in our country. So that's why I'm a bit more bullish in setting up the FX assumptions
Okay,
for
great. Okay, great, Willie. Maybe as a last point, on commodity prices that the company is relying on in terms
this.
of its profitability. How much do tariff wars actually keep supply-demand dynamics in favor of Mulia, in your opinion?
Yeah, I think with current tariff, it has been shifting the balance here. So this is also my thinking that there will be some of the implications towards the Trump tariff in the sense that those European suppliers who used to export the cheese to U.S. markets, trying to see the other markets with a more favorable tariff arrangement. And I think looking into European country relations with the Southeast Asia countries like Indonesia, I think they are having a very good relationship with I think a 0% tariff rate. So from this moment, I think this actually be more favorable for the companies like Mulia Bogaraya because the company will simply benefit from the shifting from European goods from US to these countries, these Southeast Asia countries.
Okay, great. Thanks very much for that, Willie. Well, we've come to the end of the program. And as I mentioned earlier, all of these reports, companies that we've just shared this afternoon, the QR codes can be found within the YouTube video that will be released later. So please, if you're interested in these companies, either, uh, uh, take the reports from your sales representatives, or you can basically get the QR codes and basically download the reports directly from there. Just before we end, a gentle reminder that on the 23rd of July, Maybank Securities Singapore will be hosting an event which the head of research in Singapore, Tillen, and and our macroeconomics head of research, Chua Bin, they'll be both talking about the second half outlook for not just Singapore but for regional markets as well. So please take note of this date, and if you're interested, kindly notify your sales rep to save a seat for you. With that, thank you very much for your time this afternoon, and we look forward to seeing you again next week. Thank you.